All right, it's a holiday-shortened trading week. Yay. And today is the last day of the second quarter. The S&P 500 and the NASDAQ both closing at record highs on Friday. So let's talk markets right now with Stephanie Link, the chief investment strategist and portfolio manager at Hightower Advisors. She's also a CNBC contributor. Steph, we're looking at some pretty decent-sized gains in the futures this morning. The Dow's up by 225 points. Coming after all the gains that we've seen recently, and I think when I was reading through your notes, the thing that jumped out the most is you went from 9% cash in February to just 1% cash now. And if you could, you'd be buying more even at these levels?
Yeah, and it's great to see you, Becky. I think the message is that we are actually getting through a lot of the unknowns. Right. We were very worried in March and April, because we just didn't know what was going to happen with regards to tariffs and trade, geopolitics, inflation, the Fed, and we're sort of chipping away at all of those things. Now, we don't have answers on all of them, or any of them, actually, but we're starting to get more clarity. And I think that is why the markets are acting better. And as a result, I think we can focus on the economy. And the economy, we look at the Atlanta Fed tracker. Last week, it came in at about 2.9%. So you're running at about a 2.5% GDP in the first half of this year. That should lead to better than expected earnings. Earnings right now are expected to grow for the second quarter 5%. I think you're easily going to see double that. Easily. And that is because of the momentum that we're seeing in the economy. And the interesting thing is yields continue to go lower. We're actually at a 6-week low in terms of yields. That's good for equities. And you have $7 trillion of cash on the sidelines. That's all not going to come into the market, of course. But you do have a lot of people that are kind of taking this wait and see approach. And you can't do that. You actually have to buy ahead of the certainty. And that's what I was doing.
Do you think the Fed's going to cut rates? And if so, is it going to be for positive reasons, like it's okay because we've gotten inflation under control? Or do you think it's going to be for bad reasons, like, uh-oh, there are some wobbles in the economy and in the job market?
Well, I am watching the labor market. You and I have talked about this. The weekly jobless claims is the most important data point for me in terms of jobs, and that has been inching higher. But you're really nowhere near recessionary levels. We're at about 235,000 weekly jobless claims for the 4-week moving average. You get to 260, 270, that's when I start to worry a little bit. Recession is 350 to 375. We're nowhere near that. So I am watching the labor market, but I do think the inflation has made a lot of progress. And I think maybe not July, but I do think that maybe the Fed goes in September because, yeah, they can and they should.
OK, let's talk financials. You wanted to talk about the stress test that came after the close of the market on Friday. They were better than you'd been anticipating?
Yeah. And I think, look, I think you want to be in tech, industrials, and financials. Financials is actually my favorite sector right at this moment because I do think the valuations are still very attractive. And yeah, the stress test came out on Friday, much better than expected. The stress capital buffers came down on average about 120 basis points. I think expectations were down for about 50 basis points. So much better than expected. I would tell you the winners are Goldman, Capital One, M&T Bank, and Wells Fargo. But just about every big bank saw their stress capital buffers come down. What does that mean? That just means that they're going to have excess capital so that they can actually now buy back more stock. In fact, Brian Moynihan 2 quarters ago said as soon as we get some of these regulations to ease, he was going to be buying back something like $20 billion in stock. So I expect this week we're going to hear from a number of companies and they'll be buying back stock and they'll be increasing their dividends. The stocks are like 11, 12, 13 times earnings, 1 to 1.5 times book value. And the yields, as I mentioned, are likely to go higher. And so I think that's where you want to be.
Your bigger thesis on the financials is that people are underestimating just how important and how big this deregulatory move is going to be.
Yeah, so they're going to relax the SLRs. That's important. The Basel III endgame is very important. And I think that the new news that I think is interesting is that the SEC is working with the exchanges to lower costs on companies that are wanting to come to market in terms of the IPO market. we are down from 8,000 publicly traded companies to 4,000 today. And that has to change, right? So I think you're going to start to see a lot more in terms of companies coming into the market. You're going to see better M&A, and that's also very good for financials as well. The activity in general is very good.